Every session, your chart prints two different fair prices. One is where the market spent the most time. The other is where it did the most business. Most traders never see the second one because it lives on a chart most people never open, the TPO chart, market profile. By the end of this video, you'll read both in seconds, and you'll know exactly what it means when they don't agree. A TPO chart is just time stacked on price. Split the session into 30-minute brackets and give each one a letter. A for the first half hour, B for the next. Every price the market touches during that bracket gets marked with its letter. That's it. One letter at one price means the market spent time there during that half hour. Candles show you the path price took. The profile shows you where price actually lived. The letters aren't decoration. They're a fossil from the trading floor. Market Profile was built at the Chicago Board of Trade by Peter Steidelmeyer, a pit trader with 2 decades in the pits, and released to the public in 1984. On the floor, time wasn't measured in minutes. The exchange stamped everything into half-hour brackets. A for the opening bracket, B for the next, straight through the session. And here's the part people miss. In 1984, there was no live volume at each price. Volume data arrived after the close. Time was the only thing you could watch build in real time. So Steidelmeyer organized those letter brackets on price, and the market's hidden bell curve appeared. Time at price, standing in for value. Decades later, screens finally gave us real volume at every price. Hold that thought. It's exactly why this video has 2 POCs in it. Watch a session build. A period opens and prints its range. B stacks next to it wherever prices overlap. C, D, E, every new bracket adds letters. Prices touched over and over grow fat rows. Prices touched once stay thin. By the afternoon, the shape is unmistakable. A bell curve, lying on its side. Fat middle where the market agreed. Thin edges where it didn't. You're not looking at price anymore. You're looking at an auction, organizing itself in real time. The first 2 letters, A and B, the first hour of trading, that's the initial balance. Say NQ opens at 21,480, and the first hour ranges from 21,460 to 21,520. That 60-point range is the day's opening frame, and everything after gets measured against it. Price holding inside it? Balanced day. Expect rotation. Price breaking out of it? Range extension. Someone with size wants a different price. The initial balance isn't a prediction. It's the vorm that every other read hangs on. Now find the row with the most letters. That's the TPO point of control. The price where the market spent more time than anywhere else. Fair price, measured in time. Wrap 70% of the letters around it, and you've got the value area. In our session, the fattest row sits at 21,520. That's where the auction kept coming back. Above and below it, the letters thin out fast. Time-based value. Remember that phrase because there's a second way to measure the same thing. Volume Profile measures the same session differently. Not how long price sat somewhere, but how many contracts actually traded there. The volume point of control is where the most business got done. Here's our same session. Letters on the left, volume on the right. The time POC sits at 21,520, but the volume POC prints higher, at 21,540. The market spent its time at one price and did its business at another. That gap is not noise, that's information. When both POCs land on the same price, the auction agrees. Time and volume both point at one fair price, and that level becomes a magnet and a wall. Trade against it carefully. When they diverge, read who was busy. A volume POC above the time POC means real business got done on the rally. Initiative buyers, paying up. If tomorrow opens above both, the volume shelf at 21,540 is your support reference, not the time one. Agreement is acceptance. Divergence is a tell. Still ahead, the 4-day shapes and the letter pattern that warns you a quiet morning is about to trend. Profiles come in shapes, and the shape is the day type. A balanced day prints fat and symmetric. Price rotates around the point of control, value barely moves, and responsive traders fade the edges. A trend day is the opposite. Thin, stretched, letters marching in one direction and never coming back. Value keeps migrating. On a balance day, you fade the extremes back to the POC. On a trend day, fading is how accounts die. One shape pays you to fight the move, the other pays you to follow it. Two more shapes matter. The double distribution. Two fat bells with a thin neck between them. The market accepted value at one price, repriced fast, and built a second home. That thin neck is your line in the sand. Price trading back through it means the whole move is in question. And the neutral day. Extension in both directions, closing in the middle. Nobody won. Expect the argument to continue tomorrow. Four shapes: balance, trend, double distribution, neutral. Every session is one of them, or on its way to becoming one. Sometimes a move is so fast it leaves single prints. Rows with just one letter, where price never traded again. Singles are footprints of urgency. Someone wanted in so badly they didn't wait for a better price. Unfinished edges matter too. A poor high is a top that's flat and wide instead of a clean taper. An auction that didn't finish its business. Poor highs get revisited. Singles get defended or filled. The thin parts of the profile talk just as loudly as the fat ones. So how do you actually use this on NQ? 4 reads. 1. An initial balance break with single prints behind it. That's initiative. Trade with it, not against it. 2. A balanced day at the value area edge. Responsive fade, back toward the POC. 3. A poor high or poor low nearby. That's a magnet. Keep it on your target list. 4. Yesterday's naked volume POC. Price has a habit of coming back to finish business. None of these are signals on their own. They're context that makes your existing setups make sense. So which one earns the space on your chart, TPO or volume profile? Honest answer, they're two lenses on the same auction. TPO shows you patience and structure. Day type, poor highs, the story of the session. Volume shows you commitment, where the contracts actually changed hands. Read the story with TPO. Pick your prices with volume. And when both profiles agree on a level, that's the one you build the trade around. One rule ties all of this together. The profile is context, not prediction. It tells you what kind of day you're in, where the market agrees on value, and which business is unfinished. It will not tell you when to click. Read the shape first, day type second, the two POCs third. Then, and only then, ask if your setup agrees. Trade the auction you're actually in, not the one you want. That's the TPO chart, time stacked on price, and the auction organizing itself into shapes you can read. Next time your platform prints letters, you'll see balance, initiative, and unfinished business, not alphabet soup. This one builds directly on auction market theory and volume profiles, both linked below. Subscribe and join the Discord. Links below.